Welcome, everybody. Thank you and for joining us. Welcome to this joint presentation from the BTRM, the Certificate for Bank Treasury Risk Management, and TPG Software, jointly presenting on update on US dollar Libor transition. And you're not going to be hearing from me too much, which is just as well, because I have an esteemed panel of recognized market experts who are going to talk to us for the next hour, and that hour will pass very quickly, I assure you. We're going to talk to us for the next hour about the latest and all the implications for US banks on US dollar Libor transition. In other words, replacement of US dollar Libor by the RFR, the reference rate, or is that risk-free rate, or is it recognized rate? Anyway, whichever one it is, we're going to be talking about that, and I'm going to introduce the panel right now. My name is Moorad Choudhry, founder of the BTRM. And we have on the panel today, in no particular order, I'm going to go through in the order on the screens in front of me. We have Mr. Kevin Liddy, a close personal friend of mine, a former colleague from RBS Group. I was about to say Group Treasury, but Mr. Liddy was not at Group Treasury, but he was at RBS. He is now with Solum Capital, and he is on the faculty of the BTRM. Next to him, we have, next to him virtually, of course. I'd love to all be in the same room with all of you, but that's not possible. Next to him, we have Periklis Thivaios. I hope I've done justice to your name, Mr. Thivaios, who is also faculty BTRM, a close personal friend of mine, and with True North Partners, a consulting firm, True North Partners LLP, I should say. Next to him, I'm hoping I can introduce Mr. Patrick Carey. Is he with us? Yes, indeed. Yes, there he is, sir. Yes, welcome, Mr. Carey. He is.
Thank you very much. Apologies.
Not at all. No, we've just kicked off. Right on the button. Right on the button. Patrick Carey, also faculty BTRM and an independent market risk consulting expert. And remaining on the panel, we have Mr. Rick Schnitger, is it? I hope I've pronounced your name correctly, sir, with TPG Software. And then finally, last but certainly not least, Benny Tjahjono, who is a senior balance sheet quantitative analyst with the Federal Home Loans Bank of Chicago. Welcome to you all. And as I said, this hour is going to go very quickly, I assure you. And that's also a coded warning to my panelists to do their very best, their utmost, to keep the answers as succinct as possible, as befits an hour webinar, of which I have already taken 4 minutes. Right, let's kick off with the first in our questions, which is simply an update on the market. We're going to get into the detail specifically about impact on ALM and the possibility of a term SOFR, SOFR, not SOFA, forgive my pronunciation, SOFR rate, and also other impacts. We have to remember that for different banks in the US and indeed around the world, the issue is twofold. There is the impact on the legacy book, cash and derivatives, and of course there's the impact on new business going forward. And it's the impact on that legacy book that is causing a lot of the, how shall I put it, the noise and commentary that we see. Whereas if I was a brand new bank setting up business for today, it would be less of an issue. I would just link everything to the replacement RFR. Now let's kick off with all this in mind. First of all, let's get from my first panelist an update on the market. Just where we are with respect to issues such as fallback definitions and also replacement, moving on to SOFR. We can leave for later on what this means from an ALM and a risk management perspective, but just the latest update. And for that, I'm going to ask Mr. Liddy to provide that for us. Kevin, if you would mind, please.
Oh, you've thrown me there. I thought I was going to be doing the ALM bit at the end.
You will be.
Okay. Well, a market update. Well, I mean, the RFR have been shown. The alternative reference rates, let's call them that, globally to be selected by the national champions of each country, shall we say. And if we're going to particularly talk about the US, so the ARRC, which was formed as the working body to look at all this stuff, selected as their risk-free rate the SOFR, or SOFR, as we know it, which is based on overnight rates. So therefore it's very different from Libor. It lacks a term structure. It doesn't have a term liquidity premium built in it. And so we know it's also a backward-looking rate, so it doesn't have the forward-looking nature of Libor. So this is the problem that we have with the legacy book. As Moorad says, if you were going to start from scratch, be less of a problem. You can just do new business linked to the RFR or SOFR. However, having said that, obviously Libor is entrenched in a lot of products, and pulling out of those products is problematic. And so the latest developments, to cut to where we are today, the latest developments, as you mentioned, a forward-looking rate, a term SOFR, that had been expected to be announced sometime around Q2. It looks like that's going to be pushed back, and we don't have a date on that yet. And the main reason for that is because, and it's a chicken and egg situation, in order to have a term SOFR rate, you need liquidity in the SOFR derivatives themselves. Without liquidity in the derivatives, you don't get a term rate. And what a lot of people are saying is, I cannot move until I have a term rate, and therefore I'm not doing SOFR. I'm going to carry on doing Libor. And so it becomes like circular. Now, hopefully we're going to break that circle, because although the announcement of the abolition of Libor or cessation of dollar Libor has been pushed back to the middle of June 2023, unlike the other Libors, there is strong regulatory guidance that at the end of 2021, you better not be doing any new Libor trades, because we will view that as a weakness in your risk management. So although Libor will continue to be published, it's a representative Libor, I think the liquidity is gradually going to start shifting over the course of this year from Libor to SOFR, and that is a problem and another problem which we can talk about later. But in terms of recent updates, I suppose the announcement that Libor was going away, then the announcement that dollars were going to be going away a little bit later, the lack of a term rate or the pushback of a term rate, we can start going, perhaps some of the other panels will mention some of the other things that are happening now at the moment, but I think that's where we sort of are. We're in this chicken and egg situation. We're trying to grow SOFR. I did see a very good quote recently. A lot of people saying there's not enough liquidity in SOFR and so on, and it's very sluggish to get off the ground, and that's true. However, LCH made a statement recently that if SOFR trades, dollar SOFR trades, were a currency in their own right, they would be the 6th biggest exposure at LCH. So it sort of puts it in perspective that although we're saying it's small, and it is small relative to the overall size of the dollar market, there is actually a lot of SOFR stuff going on at the moment. So,
in other words, sufficient to get liquidity and get.
It's starting to get there. It's probably less than 5% of the overall volume of dollar transactions that are based on Libor, whereas in sterling it's probably 50-50.
Yeah.
But we'll get there. But I do think we're going to start accelerating now.
Okay, excellent. Thank you very much. Good introduction. Let's look at the legacy before we then look at new business. I do want to come back to you, Kevin, on ALM practice going forward, because at the end of the day, the legacy, by definition, it's got a finite life, right? So there we go. So I'm going to come back to that on the ALM and hedging impact. Let's look at legacy first. Patrick, might I bring you here to get your penneth worth, or indeed more than penneth, if you wish. There's the impact from the cash side particularly, but also, of course, derivatives, where I've got Libor linked on both sides, on derivatives and cash. What's the impact on the legacy banking book? Just currently where we stand, and what if I'm a treasurer, I'm a CRO of a vanilla commercial bank? What should I be really concerned with today, having had the latest update now from Kevin on the legacy book for cash and derivatives? Patrick, sir.
Yeah, I mean, the big challenge, obviously, with legacy books is the loan book. There has been, relatively little progress made in the front book, and then probably as a consequence of that, not a huge surprise that there hasn't been a great deal of progress either in transitioning the back book. It's a very complex, multifaceted challenge. First of all, there are issues with existing fallback language. The older business, particularly the business pre-2019, indeed up to 2020, has fallbacks falling back to prime in the case of generally most US business, falling back to cost of funds in the case of business written on the UK docs. Those are highly unsatisfactory fallbacks for both parties. And indeed, in addition to being unsatisfactory fallbacks in their own right, clearly they are out of alignment with the fallback that will take place in relation to derivatives, which will fall back to SOFR, compounded in arrears plus a spread. So you've got difficulties there. when you look at the business, more recent business than business written, let's say in 2020, quite a bit of it has amendment approach language, which is an improvement on the earlier business written, but again has the difficulty that it's simply specifying a process. You still have to make the conversion, you still have to make the transition, go through a process, etc., at a time when many other institutions are trying to do the same thing. There's also some confusion or some ambiguity about the triggering of some of those amendment fallback clauses, in the sense that when they were written both by the LMA and by the ARC, it wasn't expected that the announcement of non-representativeness and the fact would be separated in time by up to 10 months. So I think it would be quite interesting, and Kevin indeed may have a perspective on this, as to whether some of these fallbacks have been triggered. Particularly, I think the fallbacks written under the LMA language rather than the ARC language, which probably, in the case of the ARC, it probably is fairly clear that fallback is on the fact of non-representativeness, which would occur at the end of June 2023. More recent business has typically hardwired fallback language in it. So that's somewhat more satisfactory, provided it has been carefully crafted, and in particular makes allowance for the fact that much of corporate business, particularly on the LAF side, leveraged asset side, is swapped. So provided those fallbacks have been carefully crafted, and that's a more satisfactory situation. At the same time, accepting, as the regulators have emphasized many times, that fallback really should not be a transition mechanism. It should be a last resort. It should be a backstop. So you've got difficulties with fallback language. We have difficulty then in terms of how that will be addressed, in that we know the legislative solution that has been passed in the New York State Legislature and is pending, I think, in Congress. That will not really do nothing for corporate loans or specialist loans. That's essentially geared to FRNs and some loan business where there is no fallback. We're still not sure whether there will be a synthetic Libor in dollars. That appeared to be something that was on the cards on the strength of comments by Randall Quarles back in November, when he spoke to the Senate Banking Committee, and indeed I think he spoke to the House as well. That appeared to suggest a synthetic Libor. He rolled back considerably on those comments, or else the markets have misunderstood, and you can take your pick. And we're back in a situation where it might or might not happen. There's also a question, of course, as to how that would interact with the legislative solution that has already been passed. So that's quite a complex issue in its own right. And then when you simply come to the business of repapering, I mean, clearly repapering is preferable to waiting for a fallback mechanism. I mean, clearly repapering loans from Libor to SOFR is a non-trivial exercise. The interest calculation under Libor is trivially simple. Under SOFR, you have potentially up to 60 rate inputs. You have a multiplicative formula. You almost certainly have a look back. You've got to think about how you handle waiting days, whether you use the weights from the observation calendar or the interest period calendar. So it is quite a complex process, and there's also a question of who does this calculation. So really, even in the most vanilla bilateral loan or syndicated loan, it's conversion is non-trivial. So it remains an enormous challenge. We have 2 years to go, but it is an enormous challenge to tackle that legacy loan book in that period. Sorry, I probably run over in terms of what you were really looking for, but I need some of the other topics. But
no, Patrick. Whether I was just, that last bit was just hit the nail on the head. Whether you run over or not relevant. The fact is, very, very key point you've raised about the problems still with many banks about the legacy book, especially the cash loan book.
Yeah.
That point at the end about the interest calculation, I mean, what an absolute palaver. If there was any reason simply to say, no, we're not doing it, we're not going to SOFR, give us a forward-looking term rate, then that would be it. But whether we get there or not, I don't. Did anyone want to, before I move on to the next one, I just wondered if any of our panel wanted to just add to Patrick's very useful points on the legacy impact. Did anyone on the panel want to make any further comments related to what he was saying? If not, then I will quite happily move on. Okay, right. Okay, didn't want to touch that hot potato, quite understandably. Right, okay, let's, I want to talk about any alternatives at some point. I'm sure I'll make sure there is time to spend a few minutes talking about alternatives, because it could be that the US market, being the US market, ends up not having that uniform solution, at least for the first couple of years. So I will come to that. But let's just stay on SOFR. I personally would like to pronounce it SOFR. I tell you for why, because people think I'm talking about a sofa that one sits on. Every time I say that, I think, what's this bloke talking about? Especially when I'm not talking to US dollar dealers. Right. So with SOFR, can we just talk about this term issue? For some reason, there are certain participants in the market that have a real, appear to have a real bit of, it appears to cause them aggravation. You know, there's a request for having a forward-looking term SOFR published every day, a 3-month SOFR, and certain participants, this issue appears to cause them aggravation. So let me bring in, I want to talk about the likelihood of it, an update on where we are today, and the likelihood of it, and how it, the participants, the panelists, think it might come about. Let me bring in, first of all, Periklis. Sir, what's your view and opinion on term SOFR likelihood and update?
Yeah, thanks a lot, Moorad. I mean, I can understand why people want a term SOFR, right? Number one, this is what we're used to. We're used to having a rate that has a fixing into the future, and we're used to knowing upfront the rate that we're going to have to pay at the end of the period, right? So whether you want to call it inertia or anything like that, I can understand the rationale behind that. Now, in terms of the progress there, as Kevin mentioned at the very beginning, he made 2 really good points. Number one, we do have a little bit of a chicken egg challenge. In order to develop liquidity, we need to have more transactions and vice versa. But at the same time, there's actually enough liquidity. And there's 2 points here I want to say. First of all, I don't know if anybody else shares my reading of what was discussed at the SOFR symposium organized by the ARC just last week, is that they themselves said that, actually, we have delayed the timelines, but we do think there's enough liquidity and we want to move ahead with this. All right, so that has taken away some of the uncertainty we had before regarding when we had the announcement on the 23rd of March, there was even a statement that we don't even know if it's going to come ahead. Now, what has changed in between, other than potential liquidity picking up a little bit? Well, first of all, the CME has published its own indicative term SOFR rate. They say that it's based on the New York Fed methodology. They say that it's compliant with the BMR, both the UK and the EU, and with the IOSCO principles. And on top of all of that, they're saying that it's available for free to be licensed for a number of retail loans up until 2026. So all of a sudden, even though the ARC has not approved the CME term SOFR rate, this is something that's out there and it's available. And the ARC seems that they may be losing.
Can I just quickly comment? I don't want to stop you, Paris, but although, forgive me, I have stopped you. But just very quickly, the simple fact is if the ARC hasn't approved it, it kind of means people won't really use it in practice, right? They want a reg sign-off, won't they? So the fact that it's being published, it's available, and it's probably as accurate as could be, is that all pie in the sky unless officially gets some sort of official sanction or approval?
Yeah. So it's a very good point you're making, because it kind of segues us into the discussion about the alternatives, the credit embedding term alternatives. So the CME's proposal or rate that is out there, it is still constructed based on RFRs. It's a risk-free term rate. So again, it does not embed any of the credit premium, and therefore, even though we have some term fixings, economically it cannot be considered equivalent to Libor. So what we've had here on the side is, in particular, Bloomberg's BISB, the short-term bank yield index, but there's also the bank yield index coming from EBA, and IHS Markit are also working on something. And obviously we have a Maribor, which does not have a term structure. That's work in progress. But bottom line being that in addition to the term RFR has been provided by the CME, albeit it not approved by the ARC, at least as yet, we do have a number of other alternatives that not only provide a term structure, but in addition, they also embed the credit component that we were used to having within Libor. Now, it is really interesting. Again, going back to last week's SOFR symposium, Andrew Bailey from the BOE made a scathing criticism of these alternatives, arguing that we were running the risk of going back to where we started the problem, using rates that are not well founded in transactions, that they have, that the way that they're being constructed cannot withstand the shock. I'm not the one to judge Andrew Bailey, but I'm also not going to say that we may as well just accept it as this. The fact of the matter is that clients have preferences. In the United States, we have seen a divergence in terms of, or a fragmentation in the market, but potentially also one can think it as a positive thing, right? People want something different. Now, personal opinion, I'm not sure why any borrower would want a credit embedding alternative, but that's a personal opinion. I park it on the side.
Yeah, you're probably right on the borrower side. It's on the lender side, isn't it? I'm sure you're right on the borrower side there.
But I still try to put some, facade of objectivity here, and and say that we have to watch this space. The bottom line is that even though just 2 months ago we had an announcement by the ARC that we should not expect the term rate anytime soon, because of BISB, because of the CME term SOFR, it seems that the ARC have realized that they have to move fast, or they're going to lose the game out of their hands, and term alternatives are going to move to somewhere else, with liquidity building up on top of course, being yet another factor that is supporting this. What we do need to keep in mind, this is the very last comment from my side, is that just like the UK RFR working group that has made it very clear that term rates will only be allowed to be used by a select number of use cases, in particular trade finance loans and Islamic finance loans. These are contracts that you're required to know in advance the rate, and potentially also for some retail or SME loans. It seems that the ARC is going to follow the same principle. So when a term SOFR will get endorsed from whichever vendor, there is an open RFP for that, who gets this endorsement. It seems that this term SOFR is going to come with some restrictions with regards to where they can be used or not.
Righto. Okay, thank you. Thank you. I was just going to say about if I allow certain participants like trade finance, which is quite short dated in the cash side anyway, and Islamic finance, and someone's going to say, well, hold on a second, if it's good for this fellow, then it's good for me. But we're going to leave that. I would like to stay on term SOFR if I may. Thank you for that, Periklis.
Well, 2 points to Periklis.
Oh, of course. Yes. Go ahead, Patrick. Yes.
I mean, I think I was surprised personally that the ARC came out following the lead of the SCA and the Sterling Working Group in saying it will be for restricted purposes only. I understand their logic in the sense that they are concerned about this so-called inverted pyramid, where you could get a situation where the volume of transactions in a particular benchmark or the level of business written against that benchmark could be out of all proportion to the transactions underlying that benchmark. But, from June 23, the SOFR derivatives market will be an enormous, deep liquidity market. There's no question that it will be capable of supporting the term SOFR rate. So we're really talking about, how do we get from here? Can we get from here to there safely? So I'm somewhat surprised that, and I assume they mean not merely in the near term, but in general, that that term SOFR, if it when it comes along, will be for restricted purposes only. In relation to the credit spread, the credit sensitive indices, personally, I would be surprised to see them have any significant role. First of all, because they do rely on observations from CP, CD markets, bank paper markets, which are prone to illiquidity at times of stress. The BSBY index, the Bloomberg index, and the BYI involve a least squares curve fitting process, which I think in terms of complexity and comprehension will be a step too far for some users. And it also gets you then into quite academic arguments about, well, you're fitting a linear curve, you're fitting a quadratic curve. What about heteroscedasticity? What about this, that, or the other? So I just think, though, there's an inherent complexity in both of those. Even though a business has been written against, particularly BSBY, there was a 6-month, I think, Bank of America issuance against BSBY just in the last short while. But that, was clearly an experimental trade, and 6 months is a short time period.
Yeah, absolutely. That's a very short time.
Patrick and I have spoken on this one before, and I'd like to add a couple of things.
Of course, yes.
Sorry, I was going to make one just.
Oh, sorry, go ahead. Sorry, go ahead.
Sorry. And again, Periklis has sort of made it, which is that informed borrowers, when the difference between a credit-sensitive index and a non-sensitive and a risk-free index is explained to them, will prefer the risk-free index. Now, mind you, the riposte to that, or the counter to that a bank can easily make, is to say, well, if we as banks are losing, in a sense, this shock absorber that is Libor, the fact that Libor will widen in that we have the capacity to hedge ourselves against the widening of Libor in a stress situation and be exposed solely to the idiosyncratic spread. If we are surrendering that, we want some compensation, and you, the borrower, on an expectational basis, will have to pay more than you are currently paying. So that, in a sense, is where that debate could go, but I still I'm skeptical that the credit-sensitive indices will go anywhere. But sorry, Kevin, I cut across you.
Before you do, sorry, Kevin, it's double barrels today, and then I'd like to hear your comment, and then I want to bring in Benny just on term SOFR as well. But very quickly on that point, if we were operating in a genuine Chicago school free market economy or environment, which of course the COVID pandemic around the world has put a stop to because everything is being underwritten by the public sector, but if we were operating in a genuine free market, the reference rate, the rate that the wholesaler would quote off would be its funding rate. The banks don't fund at risk-free. So if I'm lending in a free market environment, I fund at X, so I'm going to add Y to X, and that's where you borrow. And if you're the borrower, that's what you pay. The idea that that the borrower should have some sort of power in a genuine free market, that you need to link to the risk-free because that's where I'd prefer to borrow. It wouldn't actually cut any ice, but because the economic environment is so different today in 2021 than it might have been in, say, good old days, 1971, who knows? Then to suddenly give some power to the borrower, saying, why should I have borrow linked to a credit-linked element? But that's where I fund. That's where I fund, with a credit-linked element. But let's leave that aside. We don't want to go down a description discuss Milton Friedman here or Gary Becker. Let's just get Kevin in on your comment, and then I'd like
just quick. Yeah, I'll do it quickly. I think the one thing that we probably have not to lose sight of, and this comes back to something Patrick said, is when we look at sterling, right, the SONIA market, which is the RFR in the UK, has existed for many, many years. It's run alongside Libor for many years. It's been well used. Banks can price things off, and systems can handle it. In the and I think that the UK authorities said, when they start talking about a term rate, they said, well, we want you to transition. We don't want you to wait around for a term rate. And in what they're trying to do is lever you into transition to a compound in arrears rate, because they don't want you hanging around waiting for a term rate. So that's why they're saying, in my view, that's why they're saying term rates will be very restricted use. And even now, even though sterling, sterling's Libor's going at the end of the year, and we've had a SONIA market for a long, long time, it's still only 50%, or maybe just over now. Mm-hmm. And if you think about it, in the US, we could have chosen Fed funds, but we didn't. We went for SOFR. It's brand new. It is something you're going to have to take time to build liquidity, and all the problems that it's a much bigger market than we see in the UK. It's much more entrenched in cash products that don't exist in some other places in the world, and so the problems that Patrick talks about, it's a much bigger issue, which is no surprise to me. It's why it's been extended. However, I think that the regulators or the ARC saying, it's going to be used in very limited circumstances, again, is the chicken and egg thing. I think they want to concentrate people, getting the systems built, having the capacity to doing, compounding, arrears, SOFR. And then maybe they'll allow you to use term rates on a much wider scale at some stage in the future. Because the beauty of term...
That's my prediction.
Yeah, the beauty of term SOFR and overnight SOFR is if I do a 10-year swap against an overnight SOFR, or a 10-year swap against a 3-month SOFR, they trade at the same price. There's no term premium embedded in a swap against overnight, a swap against 3s forward-looking that... apart from the first fixing, there's the beauty of the overnight index curves, that there is no term liquidity premium that you'd see in a LIBOR 3-month LIBOR swap against a 6-month LIBOR swap, say, for example. So in my mind, the interbank market can trade overnight SOFR to its heart content and offer, derivatives or loans against a term SOFR, and then hedge in the market against the overnight and manage that because there is no basis. So
actually, I want to come on to that, Kevin. Actually, no, there isn't. Yeah, absolutely not at the moment.
So just to finish that point, I would agree with Patrick. I was surprised, but I think further down the line, you're going to be able to use it in more situations.
Yeah, no, I agreed, absolutely. Now, just before we round out the conversation on term SOFR, Benny, is there anything you'd like to add on this particular topic? The likelihood of it, how you see it being used, or you've heard some views here from the panel about. In due course, I think I would agree with that, what Kevin said as well, my personal view, but due course could be, X years from now. Any thoughts you wanted to add on that?
Yes. Hello, everybody. Let me ask you first then. Yeah. Okay, thank you. Thank you so much. I apologize for the video issue here because I'm running through the citrix in my company, and sometimes unpredictable can happen. You never know what something can happen in the US market, and something can happen also in the SOFR market in the US, and to put the lease here. So I really enjoyed the conversation that you guys have earlier. So a lot of color here, right? So just to introduce myself here is I'm from Home Loan Bank of Chicago, and we overseeing the mortgage market in the 2 jurisdiction state, which is Illinois and Wisconsin. And as you know it, the mortgage market is very deep, and it's especially like highly collateralized, especially if you're talking about the siblings market from the Fannie, Freddie, and plus the Home Loan Bank itself. Now, that's what the term SOFR really comes into reality, and it's really gonna hit us hard if we don't face that reality with the successful implementation, successful understanding, and successful collaboration between what I agree with you earlier is from the cash market and derivative market, right? So just to give some little bit of picture of what looking here, Home Loan Bank is maybe the forefront of what issuance of the bond in the SOFR base. So as of the February of the early this year, we have about 186 billion. Forgive myself here. That basically dwarf what Fannie does in 105 billion and Freddie Mac 67 billion. And even the non-GSE, we consider ourselves a government-sponsored entity. The rest of the guys, basically, it's maybe like 400. So us itself, it's almost like 50% of the market presence in that the SOFR bond issuance. Now, what are we saying? Like, do we really know everything? Do we have like actually come up with a SOFR term structure that actually can price in that mortgage? I'm sorry that I can say no, we're not. To be honest with you, I mean, there's so much contradiction and also a lot of like push coming from the ARC himself and also from the Fed of New York, also, of course, trying to get some liquidity in the market, which is, I would hardly say successful at 70% at best, just because of the people kind of wait in the sideline. Now, the best measure of what I'm looking here is because we catering to about like 700 member banks, 800 member banks in our jurisdiction, right? So if they actually say they picked up this SOFR ideas and say like, I want to go with that, but the problem is like part of the equation is not really filled up yet. So for example, like if you're in the cash market, for example, like you really need somebody on the other side that actually is going to pick up that risk, right? Which is probably like they will come to us, maybe the most likely, right? And then they're going to be funding it with us, but they're going to hedge it somewhere or the other way around, right? That the other equation doesn't happen yet, and it's still highly debatable. And maybe when we come to conversation with what the alternatives rate get available out there, And why are they there? Because they're actually matching exactly what the funding needs of these member banks. They're not necessarily liquid. Now, please quote me here. They're not necessarily liquid, but because it matches exactly. Now, the main problem here, before I dig deeper into the equation here, because issue is the implementation. Now, you can think about like, oh my goodness, SOFR is very easy to calculate. It's either averaging or compounding, right? So the best thing that people likely to tend to is going to the Excel spreadsheet, right? And then you start calculating. Our member banks are really mom and pop store, like down the street. They're not really even sophisticated enough to actually execute this kind of like compounding and averaging. I'm sorry to say about that. So we're really trying to consult with them and trying to see like if we can actually start digging deeper into some liquidity in the market itself, right? Now, bear with me here. The fact that if this liquidity is not happening, then the term structure is not happening. And ARC has hesitantly said that, I'm sorry, I think we're trying to target the end of the Q2 of this year, which is not happening because liquidity doesn't seem to be catching up with what the demand, at least from the Fed. So if you guys heard about like the New York legislates, this sort of like a fallback of spread adjustment to the contracts. And so it comes into two different flavor, for example, right? So the best bet of this, right, regardless of whatever happened in the market, is you agree mutually with your counterparty, right? Whatever the spread that you decide upon, right? So you stick on that, right? But if you don't, then the spread adjustment is what basically adorned by the ISDA is what your fallback, right? And right now, the New York State is happily trying to push people in that directions, right? But for example, the drawback and the hole in that is, for example, my mortgage may not be originated in New York State, maybe in Tennessee, maybe in Florida, right? Which is happening to be in a different jurisdiction. They might not fall into the same fallback what everybody's adhering to. That's a problem. That is a legal ramification that everybody's facing right now. Yeah. So I think what we really need, U.S. market is really hoping the Fed will actually jump in and saying like we're gonna be going in the same direction and the same collaboration and head on in the coherency. And I believe we can also follow from the Federal Conduct Authority of the UK, because I think you guys are really giving some good example for us to follow, you know, to say the least here.
Well,
so
I'll let you finish, Benny. I was just going to say, I'm sure the FCA will take that compliment very nicely. But do round up, so do finish your comments.
Okay,
sorry.
so yes. So basically, coming from the term structure itself, like bear in mind, because these are risk-free rate, and coming from the risk-free rate, we can talk in detail about that. Coming from the collateralized rate, right? For example, right now, well, the collateralized rate itself, which is actually Treasury, which is highly liquid in the market, right? If you can see here, what's happening in the Treasury rate in the recent days, which is really stable, even like close to zero, 0.01%. While the Libor is actually maybe popping up like about 26 basis point above that rate here, right? So coming to that point and angle here, looking up the term structure maybe like still further down the road. And what I'm saying is that there are two components that, right? Talking about the Libor, what is the counterparty risk? And that's embedded inside. So we're not talking just like compounding or averaging, mathematically speaking, right? But we're talking about like what each of the credit spread or the credit risk that you're facing for each individual term of the term structure. And that's what we're facing right here, right? And then right now, what we get in the SOFR rate, if we're trying to compounding out and it's like, yeah, we can come up with some term structure, that's good enough, right? But you don't really incorporate what's the risk of your counterparty for each individual term structure. Now, that's one aspect. The second aspect is the likelihood of FOMC deciding to increase the rate or jack up the rates, right? Right now, Chairman Powell has been really benign and saying like, hey, let's just put on hold because it seems to be the inflation is popping up right here, but let's put on hold first, right? Because we want to keep up like with this unemployment rate to be stable first, right? And the rate of the wage earners also picked up sufficiently high to basically they're saying like we're gonna do some tapering, right? And they're gonna increase the rate. So you would expect the SOFR rates on the front end, the very front end, which is actually the essential of that term structure origination, is gonna be kept low, while your Libor is gonna be popping up high because that's what the interest rate and inflation comes about.
Okay,
right?
Benny, thank you for that. Thank you. Let's just thank you for all that. You touched on a couple of things and possible alternatives. I wanted to bring in Rick from TPG on just that topic. Actually, leads very nicely onto. Is there a likelihood? Is there a likelihood that actually the market will adopt an alternative and that will take off and it'll be viable and continue? Rick, your comments on any possible alternatives and their feasibility and viability to SOFR if the market doesn't in the end take it up?
Yeah, thanks, Moorad. Thanks for having me here. Definitely
no means very welcome.
It's a great panel here, and I've learned quite a bit just listening to them. But just to kind of give you my background, so Benny works with Federal Home Loan Bank in Chicago. I'm more in the investment accounting process, where all those banks that Benny supports, his correspondent banks, I handle systems and build systems to handle SOFR and to handle these types of investments that use SOFR and things like that. So the biggest things that our customers are looking for is, are these alternative rates going to happen? There's so many that are coming out, these alternative rates, the Bloomberg rate, the ICE rate, the market rate. Everybody's coming out with these alternative rates that have that credit component. And to me, it's just, I believe that a lot of them, when it comes to those types of instruments, when we're talking about loans, and that are leaning towards those types of rates, that their customers, when they're selling those types of products, are going to gravitate towards those rates, whether it's Ameribor or some of those other more credit related rates like Libor.
And will that be a large volume? You said some of them are going to gravitate to something like Ameribor. I've seen some skepticism. Do you think that will be a large volume of people? Is your prediction?
I do, because like Benny was saying, it's really just trying to convince some of these smaller banks into accepting SOFR as a rate, and not since it is a historical calculated rate compounding over a particular period. It's just more difficult for them to understand it and really comprehend it, and selling that type of rate is difficult.
Okay. So, any comment on that from? I was going to bring back Patrick or Periklis, or both of you, just very briefly, on your views on alternatives actually taking off, or will just be all shoehorned onto SOFR, as I'm now calling it, as of this conference.
I think in relation. Sorry, Periklis, go ahead. Yeah.
No. All right. My favorite quote now is that making predictions is a very difficult thing, especially when they pertain to the future. So I'd rather hold back on this very point and just whatever happens, I will pretend that I had foreseen it. But so please, Patrick, go ahead.
I was really just going to follow up on what Rick was saying. I mean, the attraction of term SOFR in terms of transition is that it's a very short transitionary step in terms of comprehension from boards, for management, in terms of systems, in terms of cash flow management, accounting, etc. It's a relatively simple transition to make, and that clearly is one of the reasons why it continues to have a significant constituency in support of it in dollar markets more so than in sterling markets. I think one other point that perhaps is worth making when we talk about, and it really, in a sense, is similar to the point that Kevin made, that, if SOFR was a currency, it would be one of the most traded currencies. It would be a highly traded currency. I mean, if you look at the fact that we have already embedded the SOFR curve in the financial system, we use it to value the entire stock of dollar derivatives. We use it to, valuation for management purposes, risk management purposes, statutory valuation, fiduciary valuation. We use it to calculate, the collateral that has passed, or it will determine the collateral of billions of dollars of collateral that is exchanged. It determines interest paid on margin. So we've already, in a sense, entrusted it with, despite its shortcomings and its limitations, we have entrusted it with a really central role in financial system. And it doesn't seem to me, and that clearly there is insufficient liquidity, certainly in the OIS market, at present to support an OIS-based term SOFR rate. But, you know, certainly what kind of strikes me is that it can't be beyond us to get, in a sense, from here to June, safely from here, with a few wobbles along the way, from here to June, if there is an appetite for a term rate, in the knowledge that once you reach June 2023, you're looking at an enormous SOFR derivative market.
I've got to believe that with you that it's slow getting off, relatively slow when you look at the percentage of SOFR versus Libor. But that statement that, you know, it's the sixth biggest currency in its own right, if it's sixth biggest risk if it was a currency in its own right, LCH, really made me think. And also at the symposium, there was a guy from I think he was from Wells Fargo, and he said, actually, when you look at the volume of SOFR transactions that are currently being talked about, it's actually quite misleading, because 200 trillion of the market has already signed up to fall back to SOFR, you know, on the 23rd of June. So, and if you think about the existing legacy derivatives, they actually are SOFR swaps plus a spread, you know, and because Libor now is SOFR plus a spread.
Yeah.
The two markets are completely merged together now. So the projection of Libor is, you know, and the projection of term SOFR plus the spread equates to Libor. The two things are circular. So I do agree that there are going to be alternatives, and we'll talk a little bit about them in the ALM section. But I do agree there are going to be alternatives. But it really comes down to two things, right? One is the ease of transition that you mentioned. So a term rate is just, I won't go to that screen and get Libor, 3-month Libor. I'll go to that screen and get 3-month SOFR. Right? It's forward looking. I just plug it in. I've got the same systems. I don't have to change anything. That's the ease of transition.
That would make it so easy. That would make it. But then
the other side, the other thing that, you know, and we come across this in the UK, and you know, with our old house NatWest, it's about education. Yeah, there are two aspects to this. It's one is, what is the ease of plugging in a term rate, and if I can't use a term rate, what is the problem with a compounded in arrears backward-looking rate? Right, that's an educational issue. Right, so it's a question, and I think, you know, Rick, you said it. You know, and someone else said, you know, you got to make the board understand what you're doing. Yeah, that's right. And it may be a good thing in the end, right? Because, you know, if you think about a risk-free rate is probably the soundest observable rate that you can ever have.
I wouldn't disagree with that.
So maybe it's a good thing. Maybe it's a good thing, you know, that we go through this, and it's a question of education, right?
Well, there is that as well. Thank you for that, Kevin. I just keep an eye on the clock. I did want to talk about going forward, new business, ALM policy. Let's try and squeeze a minute or two for that. But before I do, I just wanted to ask, did anyone on the listening in now, did anyone have any questions that I'd like to put to the panel? We have time for one or two. If you want to just unmute the mic and put your question, we would welcome it. Please just introduce your name and your firm, and then just put the question to me, and I will pick I'll pick the most appropriate panelist to answer it. No, not all rushing at once. Okay, that's great, because that means I can just carry on asking my own. Okay, no problem. So, first of all, that last point, Kevin, completely agreed on that. But the thing about a term SOFR is, I transact today, and I'd like to know what interest is being paid or received in 3 months' time. That is why people are talking about it. And I know I see a lot of anti-comments saying, look, you got the overnight one, just go with that and compound arrears. What's your problem? And theoretically, it isn't a problem, but practically, it puts some people off, which is why we have this discussion of alternatives. Let's park that for now. And I'm going to come back to you, but I would also welcome any comments from any of the rest of the panel, Benny as well, if you're interested in this last point. Just going forward, from the point of view of the ALM practitioner, the treasurer, head of ALM, head of balance sheet management, what's the implications going forward in the US dollar markets? Let's assume the market is going in the way of SOFR, term or otherwise. What should we be concerned with? Two or three, the top two or the top three concerns or issues that I should keep my eye on and be focused on, and educate the board and the ALCO, the ALM committee, on going forward in the new SOFR regime? Kevin, your thoughts on that?
It's a very big subject. I'll try and focus on a couple of things that always spring to my mind. First of all, the job of Treasury / ALM, in my mind, one of the most important jobs is the setting FTP, right? So the funds transfer pricing curve that's used, properly indexed or properly sized in terms take into account where do I borrow and then at what rate do I lend and maintain my profitability, right? So historically, it's always been a LIBOR-based curve. It should by now be a SOFR-based curve, right? Yeah. I have no doubt in my mind, right? You could argue that, there's going to be Busby and there's going to be the ICE Bank Yield Index and there's going to be Prime. We've got lots of different dollar indices at the moment anyway. You've got Fed funds, you've got different LIBORs, you've got 1s, 3s and 6s, 12 months, you've got Prime, you've probably got other rates out there as well. So there is always a mixture of indices. But we selected one index against which to benchmark everything, and that was 3-month LIBOR. And that's pretty much a global implementation. That's got to change the SOFR in my mind.
Yeah.
Yes, there'll be other indices out there, but from an ALM perspective, it gives you an opportunity perhaps to look at that index basis risk that is embedded in other business lines and say, okay, I'm going to bring it back under the auspices of ALM and manage it centrally. Right? Might be an opportunity to do that, but certainly constructing the FTP curve to be based off SOFR.
Yeah, absolutely.
One of the questions I got asked when I said that was, how can you do it SOFR as an overnight rate and there's no term structure? Well, yeah, but even now, when you think about, you can get your head around a 10-year FTP curve that's based on 3-month LIBOR. Well, 3-month LIBOR doesn't have a 10-year structure either. What you're really doing is looking at the 10-year swap against 3-month LIBOR.
Yes,
and in the same way, you would do the 10-year swap against SOFR, and you would build your curve that way. So there is a term structure to SOFR.
Yeah, you just use the SOFR swap curve.
Use the SOFR swap.
Exactly.
Curve, right?
Yes. Yeah.
So let's park that one. As I said, there are lots of index basis, whether it's Prime, whether it's Fed funds, and now you're going to have Busby and whatever you're going to have. You need to manage that, right? But the one thing you have to do is you have to understand how that spread impacts you as an institution. So, and this is where it gets complicated. I understand the reason why some banks would like to have a credit-sensitive rate on their asset side, because in the event of a funding shock, when their funding costs go up, at least they get some recompense because average LIBOR has gone up as well. Yeah. Okay. Well, that works if there's a market shock and it's not your own shock, because that isn't reflected in LIBOR. Your idiosyncratic funding costs are not reflected in LIBOR. So an average funding, yes, you get some payback because your assets appreciate or reprice. That to me, again, is a fundamental ALM question. Because one of the things that an ALM desk should be doing is it should be looking at its structure of its funding. I'll give you a classic example. If as a bank, if I issue term funding, so I issue a bond, I should be swapping that to SOFR, right? I should have SOFR on my liabilities, because the more SOFR liabilities I have, the less I'm concerned about having SOFR assets. Right?
Let me, and in the interest of time, thank you very much, Kevin. I would love to listen to you more, but listen, let me just summarize that. Actually, if I'm an ALM manager,
5 minutes,
if I summarize, if I'm an ALM manager, why don't I just, to use the fund manager's expression, immunize everything to overnight? I lend and I transform that to overnight, and I borrow and I transform that to overnight, and I've got a balance sheet that's overnight floating. I can sleep easy at night. So I'm just extending your point. I would issue a 1, 2, 3 year, 5-year MTN, and I would just swap that into floating, so my funding cost is floating to that, and same for lending. So immunized to floating overnight both sides of the balance sheet, then everybody sleeps easy. So completely agreed. I've just got some questions on screen which I want to go through very quickly. Benny, I'm going to run this one to you very, very quickly. The question is, why not just go with SOFR as the new RFR? Your very quick answer to that one, sir.
I like to add to what Kevin was mentioning because it's really worth it, right? Because maybe touch on some ALM,
You have
right?
just 1 minute, sir. You have 1 minute.
Okay, so basically what the SOFR curve in the Bloomberg platform, for example, essentially is OIS. So be careful about that. So the only thing like why we don't lend out beyond the 2 years, because we can trust only 2 years futures curve, which is like linear compared with the compounding beyond the 5 years, right? So that's why we can only go 2 years, maybe 5 years at the most, right? So what you're looking at the platform is actually OIS SOFR proxy. So essentially OIS curve, if you can see it that way, right?
Yeah.
Okay, so there's not much SOFR curve. It's basically practically nothing out there, right? So
well, I'd have to disagree with that. I will come across and disagree because I do some work with one of the largest US derivative money brokers who will quote you SOFR swaps out to 50 years.
Right, but it's very interesting. In fact, let's
they
agree.
do exist, right? But we'll agree.
Only 4 minutes. But let's agree because it's very interesting. No, I understand where you're both coming from, actually. But in the end, I would love to talk for another hour, gents. But it's very interesting that Benny doesn't see it. You know, you're talking to this broker, and he or she is saying, "I can quote 50-year SOFR swaps." Whereas Benny is saying, "I don't see it." So there's a disconnect there practically in the market. So I think
education.
And as the chairman, I'm going to say you're both right, okay? Because I know which side my bread is buttered, so I'm going to say you're both right. Just some more questions on the screen. I'm just going to read them out. First of all, why isn't SOFR swap liquidity much higher now if LIBOR curve is simply SOFR plus a spread? Liquidity should have moved as not. I really think absence of term SOFR is a large issue for cash markets, especially loans. I mean, my personal view is I think the cash market is the one that really is interested in a term SOFR. We've talked about term SOFR. Another comment, again, maybe Kevin, for you. Actually, before, just a quick quote. A correspondent called DC has said, quote from Vice Chair, is that Qualls? Qualls. The Federal Reserve's position is that banks must be prepared for the LIBOR transition, not that they must transition to a particular rate. Well, that's a little bit more user-friendly than the FCA, isn't it? The FCA is saying you will be there and you will do it. A bit like you've got to come to my party, otherwise I'm going to exclude you. One more question in the last 2 minutes before I thank everybody for their participation, because as I said, the hour's gone really quickly. On deposit FTP, or just the FTP curve, how would you convert the FTP base rate and LP, a liquidity premium, to SOFR based? Kevin, do you want to take that, or
in 2 minutes? How do you do it for LIBOR now? So I know I issue 5-year bonds, and I know it gets bought at a certain price, and I know where the 5-year swap is, and therefore I asset swap it, and it says I've just issued at LIBOR plus 50. Right, so 5 years is LIBOR plus 50 or LIBOR plus 100 or whatever. You do exactly the same thing, but you use the SOFR curve, and you get SOFR plus 75, right? In a minute. There you go.
Excellent. That's what I've been trying for a very long time to get all these BTRM faculty to write a book on their expertise. I'm already hassling Periklis, I'm hassling Patrick, and I'm hassling Kevin for just this reason. Very last question. We've got 1 minute. Why, with SOFR, how would we perform the EVE calculation as part of IRRBB? I'll take that. It's exactly the same way. You just build your discounting curve from the SOFR curve, which Kevin has said exists out to 50 years. Benny is saying he doesn't see it. I want to give both of them the airtime they need or they deserve. But it's exactly the same. You're just using a different discounting curve that's now SOFR based and not LIBOR based. Excellent. Thank you very much, everybody. I don't know about you, but it went very quickly and I enjoyed it very much. Let me first of all thank my panel, my esteemed panel. First of all, the 3 faculty members from BTRM, Periklis, Thivaios, who is going to be writing a book on FX forward forecasting, Kevin Liddy, faculty BTRM, and Patrick Carey, faculty BTRM, and our 2 special guests, Rick from TPG Software and Benny from Federal Home Loan Bank of Chicago. Real pleasure, chaps. Thank you for joining me. Thank you for the conversation. If you have any further comments on this, the delegates attending, do please send a message through to your admin team from BTRM who connected you to this. I will bid you good day, and do please keep in touch. And thank you again. Take care of yourselves, everybody. Bye-bye.
Bye.
Lot.